Stop scrolling. You're about to learn how to turn your trading account into a cash flow machine using the mighty wheel strategy. If you've ever wanted to make money while waiting for stocks to move, this is the strategy the pros use. And today, I'm breaking it all down for you. This strategy works in bull, bear, or even boring markets. Stick with me because by the end, you'll know exactly how to run the wheel like a pro. Plus, I've got a free bonus for you, so stay tuned. Okay, well, what is the wheel strategy? It's simple. You start by selling a put contract on a stock. You receive money from the buyer, known as premium, that is yours regardless of what happens next. Basically, you are just offering to buy the stock from them on a future date at a price you set, and you get paid for that. Then, at the point of expiration of this option, one of two things will happen. The stock will stay above your strike price, and you have earned the premium you originally collected. Go back to step one and sell another put to start all over. Or the stock will close below your strike price, and you will automatically be assigned the shares of stock. Being assigned simply means that you purchase the shares at the originally set strike price. So if you originally sold a put with a $100 strike price and the stock closes at $97, you will have bought the shares at $100. Not to panic. Now you have the opportunity to sell calls against your shares for more premium collection. This is the second part of the cycle, collecting call premium while you're waiting for the shares to rise again. At the expiration of the call option, one of two things happens. Either the price of the stock remains below your call strike price, and you sell another call option and wait a little longer, or the stock prices return above your strike price, and you sell the shares at that price. At this point, you have come full circle, hence the name wheel. Time to repeat. Sounds good, right? Well, let's look at a real live example to see just how good. Let's look at one of the companies in the Dow Jones Industrial Average, the McDonald's Corporation, symbol MCD, and let's walk through the past 6 months to see how well we would have fared. Starting mid-August, we would have sold a put on MCD at the $275 strike price with about 30 days to expiration. This was about 5% below the current price at the time and collected an estimated $1.50 per share. So, one contract would be $150 in premium. We wouldn't have to do anything again until mid-September. At this point, the share price has risen, and the initial puts expire worthless. Now we can sell another put, but this time at $280, and we collect another $1.50, or $150. In October we do it again. This time our put strike price is $295, and we collect another $1.50, or $150. So far, we have never actually owned MCD, but have collected $450 in premiums. Not too bad. Then the market moves downward, taking McDonald's with it. In mid-November, the stock closes just under $295 at approximately $292. Now we change gears and begin selling calls, waiting for the shares to rise again. For the purposes of this example, we sell calls at the purchase price or $295. Because the stock is trading close to this number, we receive more premium, $2.70 or $270. Interestingly, McDonald's declares a dividend of $1.77 per share, and since we own the shares over this time, we received $177 in dividends. So add that to our income, the stock rallies and our shares are called away, meaning that we sell our shares at $295, the call strike price. Perfect. Now we start over, selling another put, this time at a strike price of $285. Now the market falls again, and we are assigned shares at $285 and switch back to calls again, selling the $285 calls with a February expiration. The stock price is a little further away, but we still collect $1.75 in premium or $175. While the option is still open, the recent price above $300 per share indicates that we will likely sell the shares at $285, rounding out 6 months of the wheel strategy. Well, in total we earned a total of $1,222 over the 6 months. Assuming a maximum capital outlay of $29,500, this is a 4.1% return over 6 months with a full allocation of funds. Depending upon your account type and broker, your return could have been substantially better. For example, for my account at Interactive Brokers, the capital allocated for this strategy would have been $7,500 or less before being assigned. If I factor the true economics of this strategy for me, it would be as follows. $7,500 capital for 4 months, $29,500 for 1 month, and $28,500 for 1 month, or about $14,700 average capital applied. This means the return on my average capital would be 8.3% over 6 months, 16.6% for the year, plus my unused capital at Interactive Brokers earns interest over 3.5% at last check. This is why I recommend Interactive Brokers. If you want to earn like a pro, check out their link in the description and move your account there. Use the link below to earn a sign-up bonus of up to $1,000 in Interactive Broker shares when opening a new account. Well, on we go. The McDonald's example is a good one, but there are potential issues and pitfalls with the wheel strategy that we need to be aware of. If you are looking for capital appreciation, this is not the strategy for you. Selling puts or calls limits the amount of earnings you can have. Stocks that rise quickly will leave us in their dust, and we can only earn the premium collected. Also, we have full exposure to the downside with this strategy. Any significant down move will take us with it. The further the prices move away from our entry point, the harder it becomes to sell options at break-even levels. Take the example of Peloton, symbol PTON. After the COVID pandemic, with the new emphasis on staying home and active, Peloton took off. If you started the wheel strategy in August of 2020, you had a really good 6-month run, collecting premium and never buying shares. However, that run ended in February of 2021 and hasn't looked back. You would have purchased shares at $140 or $145 and haven't seen that price since. In fact, Peloton recently closed just under $10. The severity of the drop meant that selling calls near $140 or $145 would have been impossible. This is an example of the wheel strategy not working and why it is important to pick the right stocks. The success of this strategy depends heavily on choosing the right stocks. Focus on stable companies with good fundamentals and steady or moderate uptrends over time. Avoid high flyers. A quick up can often mean a quick down. Make sure that the stocks have an active options market. This means liquidity, open interest, and tight bid-ask spreads. Look for moderate volatility. Stocks that trade in a range are best. Highly volatile stocks, even though premiums can be higher, can often be issues with large price movements. Comment list and we'll send you our top 10 wheel strategy stocks. That's list in the comments. Also, if you find this material valuable, please like and subscribe. It's a big help. Well, that's the wheel strategy. It offers traders the potential for steady income and solid returns when applied correctly. By systematically selling puts and covered calls, investors can generate consistent premiums. However, choosing the right stocks is critical to the success of this strategy. Remember, if you want our top 10 wheel strategy stocks, mention list in the comments. Thank you for watching. Until next time, good luck out there. As always, the information presented in this video is for educational purposes and should not be considered financial advice. Be sure to evaluate how this information and securities discussed align with your financial needs. Consult with a financial professional if needed.